Welcome to the Real Estate Guys radio program. The vast majority of real estate investors start with single-family houses, and there's a lot of reasons for that. But if that's you, what's next? That's what we're going to talk about today, making the jump from one unit to multiple units on the Real Estate Guys radio program. All aboard! Registration is now open for the Real Estate Guys 16th Annual Investor Summit. Imagine spending an entire week with like-minded investors, world-class educators, and real-world professionals. Returning this year are sales legend Tom Hopkins, international developer Beth Clifford, the authors of Prosper, Chris Martenson and Adam Taggart, and the author of The Creature from Jekyll Island, G. Edward Griffin. And joining us live and in person for his 6th Investor Summit, Peter Schiff. And lots more to be announced. It all begins April 6, 2018 in Fort Lauderdale. Visit realestateguysradio.com and click the tab that says Summit to learn more and reserve your spot. This transformational week is like no conference you've ever attended. Go to realestateguysradio.com and click Summit and make plans to spend a week with the Real Estate Guys and an all-star faculty on the 16th Annual Investors Summit at Sea. Don't miss the boat. Welcome to the Real Estate Guys radio show. I'm your host, Robert Helms. With me, as usual, co-host, financial strategist, Russell Gray.
Hey, Robert.
We love to talk real estate, and there's kind of two categories of folks that listen to the show, those that are investors and those that want to be. And when you're starting out in real estate investing, very often your first investment is a single unit property, a townhouse, a condominium, a single family home. We all understand those kinds of units. They're easy to find, lots of them on the market, multiple entries, multiple exits. But this show today is really designed for that next level investor. It doesn't mean that if you haven't invested before, you don't want to listen, because this would be the next step for you if you start as a single family home investor. But how do you get to the duplex, triplex, fourplex investing?
Yeah, there's a lot of reasons to like multifamily, and it's the natural progression from a single family residential investor because, most people start out with a home because they understand it, right? They grew up in a home, they live in a home, but it's also easy to understand apartments and, but the idea of buying 100 units or 200 units or 300 units, that can be pretty daunting. And today you're going to have a little bit of experience on your resume. So it's that old adage, like when you're going out to get your first job is, well, you're only going to give me a job if I have experience, but how do I get experience if I can't get that first job? And so the jump from a single family home to a small multifamily property is a great way to begin building that body of experience that you're going to need when you go to get that bigger multifamily property and that bigger multifamily commercial loan.
Yeah, such a good point. People think multifamily, what is that? Is that 5 units? Is that 16 units? Is that 700 units? Well, yeah, all of that. But where do you start? There are people that decide to invest passively in a larger acquisition. A bunch of folks get together and buy a 100-unit apartment complex. Absolutely a way to go. But to really roll your sleeves up and understand the business, we've always liked multi-unit properties. I remember we did a panel on the Investor Summit several years back called Getting from Greenhouses to Red Hotels, right? How do you on Monopoly get from single-family houses? And on our panel were Kenny McElroy, who, of course, today he and his partner Ross have 10,000 doors, Kim Kiyosaki, who is an amazing real estate investor, the godfather of real estate, Bob Helms, been investing in 7 different decades, and then we had CPA Tom Wheelwright do the tax portion of it, and I moderated it, and what every single person on the panel had in common is we all started with a 2-bedroom, 1-bathroom unit. Whether it was a single family house or a little condo, we started with just a 2-bedroom and grew our real estate portfolios from there. Not everybody starts there, but since so many people do, if you're a single family home investor, how do you get to that next level? It's very similar, but it's not exactly the same. A single family home could be sold to another investor, for example, but is often sold to an owner-occupant. Rarely, if ever, is a multi-unit property sold to an owner-occupant.
Yeah, there's the pros and cons, right? Because when you go to buy a single-family home, you can sell to another investor if it's a good investment property, but you could also sell to an owner-occupant. That's the pro. The con is that when you're going to purchase the property, you're competing with owner-occupants. And sometimes owner-occupants will bid a property up because they want it, because they have good income, because there's inexpensive loans in the marketplace, and they bid it up to the point where it doesn't make sense sense as an investment property anymore. When you make the leap to a property that is much more of an investment property than it is a residential owner-occupied type property, you have less people bidding it up beyond the point that it makes sense. And so that's an advantage. The other part of it, me having come out of the mortgage business, even though we talk about residential lending from a lending perspective is 1 to 4 residential units. When you go 5 units and above, that's now become commercial lending, even though you might be buying a residential property. They're two very different lending programs, and just the whole process of getting a commercial loan on a multifamily versus 1 to 4. So one of the other advantages of going from a single family home to, say, a 2, a 3, or a 4 unit property is you're still dealing in that realm of conventional residential loans that are fairly easy for people to qualify for based on their own personal income and their own personal balance sheet. And so that can be advantageous, especially if you're trying to pick up a property maybe that has a little upside potential that you're going to need to develop first. Whereas with an apartment building, it's harder to do because the income on the property itself is what has to carry the day. And if it's not performing well, you can't just go in there and augment that with your own personal income.
Our guest today started out like most of us with single-family homes and then discovered pretty quickly the attractiveness of multi-unit property. He's got a great story. Plus, he's found out a really cool way for investors to make the leap. You'll meet him when we come back. You're tuned to the Real Estate Guys radio program. I'm your host, Robert Helms.
Live nationwide, you're listening to the Real Estate Guys. Find out more at realestateguysradio.com.
This portion of the Real Estate Guys radio program is brought to you by International Coffee Farms, where you can own a parcel of land in your very own specialty coffee farm in Panama for as little as $15,000. Here's how it works. Deeded half-acre parcels entitled Specialty Coffee Farms in Boquete, Panama are turnkey managed professionally on your behalf by a team of local experts. Sustainable average income is estimated at 12%, and cash flow can begin within 12 to 15 months from the date of your parcel ownership. International Coffee Farms' mission is to own and operate specialty coffee farms that are economically, environmentally, and socially sustainable. As part of this mission, 20% of the gross profits of each farm is committed to a socially sustainable fund to improve the lives of the Panamanian coffee farm workers and their families. International Coffee Farms currently owns and operates 9 specialty coffee farms with half-acre parcels available for immediate ownership. To find out how you can become a coffee farm owner in Boquete, Panama, email coffee@realestateguysradio.com. That's coffee@realestateguysradio.com.
Hi, this is Patrick Donahoe, CEO of Paradigm Life. Wall Street and banks spend billions of dollars per year in advertising with the goal to convince you that they are the solution. But take a look around. None of their advice has worked. If you're listening to this, odds are pretty good that you're already a real estate investor, or at least becoming one. So why do you do it? Is it to hedge inflation, the tax benefits, or maybe it's to get your money away from Wall Street? It's because of these benefits and so many more that I created the Real Estate Investor's Guide to the Perpetual Wealth Strategy. When you combine successful real estate investing with the Perpetual Wealth Strategy, you have the recipe for what has helped the wealthy to establish their financial well-being for decades. You can download the Real Estate Investor's Guide to the Perpetual Wealth Strategy today by clicking the Resources tab on the Real Estate Guys Radio homepage. Don't wait, go download it now.
Hi, this is Simon Black from SovereignMan.com, and you're listening to The Real Estate Guys.
Welcome back to the Real Estate Guys radio program, heard every weekend on this great radio station, all the time at realestateguysradio.com. We're talking today about making the jump from single family to multifamily. It's just kind of the first jump that a lot of folks take, and the gentleman you're about to meet has made that jump. He's actually started earlier in the process by buying and flipping houses. Let's say hello to Steve Olson. How are you?
Hey, great. How you doing?
Very good. Good to have you on the program. Steve, we're going to learn about what you guys do today because it's really amazing. But let's start with how you got into the real estate investing world.
Sure. It was quite a start. People ask me that all the time, and I have to think about it for a while. You end up where you are, but I was in college, believe it or not. I was going to be an attorney, and I think I dodged a bullet there, but I was graduating with a degree in political science. I had 12 credits left at this time, and I was working for a real estate guru in the administrative side of things, shipping boxes, answering questions, that kind of stuff. But down the hall were these real estate coaches, and you got to keep in mind, this was back in 2001-ish. through 2002. And it was a lot easier to flip a house back then. The competition was not near what it is today.
Yeah.
The market was a lot more inefficient, and frankly, that was a good thing if you're a house flipper.
Sure.
What happened one day is a friend of mine we put a house under contract together, and I got a text message while I was in one of my classes, 12 credits away from graduating. It was at a time when text messages were 25 cents to send and receive. And one of those BlackBerries with the wheel on the side.
Sure, yeah.
And I got this text message thinking this better be good. That was a quarter. I'm in college. And it was a message from my friend, had a check for me for 17 grand, never looked back. Wow. And I've had all kinds of stops along the way. A lot of rentals, right? Single, multifamily rentals. I've done this land assignments, wholesaling. I've done retail flips. So just a lot of different stops along the way, so I can look at it in a perspective that understands some of the strengths and weaknesses. There isn't a perfect way to do this. You got to kind of pick your poison.
Yeah.
And I've kind of settled into this multifamily thing. I really like it for some specific reasons. And
let's definitely talk about that. But before that, this idea of buying a house and doing some work to it and selling it at a profit, right? Flipping property. There's a lot of podcasts that specialize just on that. We're certainly not against that idea. We just talk about the fact that that's not really real estate investing, right? Chapter 1 of Rich Dad, Poor Dad. The rich don't work for money. They put their money to work. And investors put their money to work. They don't roll up their sleeves and trade time for dollars. But it doesn't make it a bad thing to do. And obviously, in college, making $17,000, that's a big, exciting thing to have happen to you. But you have to think about where does that path lead? What's the eventuality? Why is it that you're not a house flipper today?
Well, it's really glamorized. In fact, I'm here in town, and I'm with my wife.
Yep.
And we went down to Waco, Texas a couple days ago. That reality show, Fixer Upper.
Yep.
It's the biggest one there is right now. And they got their start in house flipping. And that's not really what they do anymore. But it's made to look so glamorous. And some guys have a knack for this. It's managing the trades. It's finding a steady stream of houses.
Yeah.
And like I said, you can make money. You can make good money doing this.
Sure.
You just got to know what you're getting into. And what didn't work for me personally was when you're doing it to run a business and earn a living, well, you've got to buy a certain amount of houses every month. And when it comes to investing, I don't like to use the phrase, I gotta. Right. You've got to buy a house.
Right.
Emotion is creeping in. You start talking yourself into, well, if I do this to it, then it's going to be worth X amount of dollars more. Maybe I'm the high comp. And you know what? Sometimes you're right. But when you're wrong, it really hurts.
Yeah.
In flipping. It really stings badly. So I just felt like that's a good place to generate some capital so you can invest it.
Sure.
If you've got a knack for it, you can generate some capital flipping, and you should really talk to somebody that knows it and that is doing it so you can understand what you're really getting into. I don't think either you nor myself is saying that it's good or bad. You just got to know what it is.
Yeah, such a good point. We always concentrate on what we call personal investment philosophy. Who are you as an investor, and get that figured out. If you've got those skills and those relationships and you know the market and you've got a pipeline of properties, well, awesome. But I will say most people I meet who started in that part of the business haven't stayed in that part of the business. They've done exactly what you said. They put together a pile of money that way, and then they figured out how to invest in something. And the vast majority of listeners to our show invest in single-family houses. Now, we talk about all kinds of stuff, agricultural and syndication and development and all kinds of things you do in real estate. But kind of the bread and butter of buy and hold investing in real estate are single-family houses. And what we're really talking today is once you've figured that out, if that's where you start, and you don't have to start there, but there's a lot of reasons people do. People start with single-family because they know it, because it's the things we talked about before we brought you on. All that makes a lot of sense. But now when you jump up to multifamily, even something like a duplex, it's a change in thinking because a single family house could be owner occupied, could be a rental house, and in many neighborhoods you have both. But as soon as you go to any multifamily, now you really are catering to tenants.
That's correct. And I agree with you in that it's a natural progression for many people. I like to relate it to the game of Monopoly. Okay, what do? You buy the greenhouses.
Yep.
And then eventually you trade up into the red hotels. And for most investors, that is going to make sense. A reason I like that, and I'm not dodging your tenant question. A reason I like that is because I think it fully maximizes the Fannie Mae mortgage.
Yeah.
I mean, we have such a great advantage here in America. 30-year fixed rate mortgage, and it's been on a tear for the last, 8 years,
Yep.
right? It's not always been that way, and I think we're forgetting that.
Right.
And it's a way to borrow that debt at a cheap rate and maximize it, because Fannie Mae mortgage, they can do a 1 to 4 unit building. Right? So a duplex, a triplex, a fourplex. It's that fixed rate financing, and you want to get as much of that as you can as long as you're making smart buys, in my opinion. But it's a different game in that the valuations of these kinds of properties, this is where it gets a little weird. They're valued by cap rate in many cases.
Yeah, sure.
But the financing that investors want to use to get them is done by appraisers that get comparable approaches on their appraisals.
Yep.
So you're buying it based on the income it generates. Appraisers value it based on the comps that are out there. And that's kind of a weird world.
Yeah.
Because as you said, it comes down to tenants. And you've got comps out there. You've got landlords that you can use the slumlord term, or they're not taking very good care of their properties. Therefore, the rents are very low.
Or just what we call lazy landlord syndrome.
There you go.
If they bought it 10 years ago and they put tenants in and it's covering their costs and they're making money, they're like, hey, let's not rock the boat. I could raise the rent 80, but if somebody moves out, then I've got an empty unit, right? So you see
Exactly
those
right.
kind of comps.
Yes, exactly. All of that's out there. So I don't want to call it a confusing space in the market, but there's no set rules, right? A little bit of anarchy going on in that, because it's that bridge between apartment complexes and a single family house.
Well, and there's the other side. Financing is such a big part of it, as you mentioned.
Yeah.
But if we go 5 units and above or into commercial financing,
Correct.
here's the challenge with that. Most 5-unit buildings don't trade at a price high enough that the loan is large enough for a commercial lender to be interested, right? Because that's a whole different world of financing, commercial mortgages. And if I'm buying 200 units, well, then that's what I'm going to do. I'm going to get a mortgage like that. It's going to make a lot of sense. There's a lot to know about those mortgages because they often can't be prepaid. There's defeasance. There's all kinds of issues to understand, debt coverage ratio. But when we talk about a simple loan on a 2 or 3 or 4 unit building, it does a couple things. It stays within those guidelines that allow that loan to look and feel better and be less expensive. And that money's available. Whereas I might find a great 6-unit building. I was looking at a building the other day that was 7 or 8 units and the purchase price was $300,000. I'm thinking, who is ever going to make a loan on that? You're not going to find a commercial lender to make you a $200,000 loan on a $300,000 building. You're either going to buy it all cash or you're going to raise money to do it.
Yeah, and a funny thing about that is I think it's a misconception that's out there. People say, well, yeah, it's 4 units or under, so it's got to be a conventional loan. Commercial guys can loan on that if they want.
Sure.
And that's to your point. They don't want to. Right? It's just too much work for such a small loan.
Right.
So that I like that fourplex size because it optimizes both sides of the fence. You get a lot of the good virtues of a commercial property, the diversity, right? You've got one payment, but you have 4 doors.
Yep.
Right? You get that low fixed rate. And frankly, too, on a lot of commercial paper, you got to keep in mind there's a 10-year balloon on that.
Yep.
Right? So what's happening in 10 years? I mean, usually you've got your principal paid down enough to where you can deal with whatever's got to be dealt with, but you don't know that.
We saw lots of folks in 2008 deal with that exact same thing because of the timing of their mortgage. Whereas the space we're talking about, 1 to 4, there's so much demand in that space that even 10 years from now, we may not know rates and terms, but we certainly know there will be something available, right? We're just studying that market. That money's always available. So
but guess what, though? It doesn't have to be available.
Right.
You're on a 30-year fixed. Right. So you're probably going to refinance if it's lower.
Yep.
Right. If prices have gone up, you can sell. You've got more buyers in that range. And hey, we have buyers where we'll package up fourplexes under one tax ID that do come in with commercial.
Yeah.
If you know, it's kind of like flipping. If you know how to play that game, that's a good smart move for you. But once again, back to the flipping, you just got to know what it is, what you're getting into.
Well, before we leave financing, because I think this is another critical thing, is investors have this idea that they're going to acquire property over time. They're going to build up a portfolio. And again, most real estate investors are part-time investors. They've got something else they do to live, thrive, and survive, and they're putting away some property. Well, good on them, right? That's amazing. But because of the way loans are structured here in the U.S., there's a maximum number of single-family or 1 to 4 unit loans I can get. And so we were talking a little bit about this before we started recording, the fact that there's all these folks who are after the $60,000, $70,000, $80,000 house because it doesn't take that much money to get into it. But pretty soon you deploy some assets and you get to the point where you can't get any more loans. Now you're stuck. I like the fact that I can buy 2, 3, or 4 units at a higher price, meaning higher loan value, and that's only one loan that counts against me, if you will.
Correct. It's a much better use of those very valuable, limited Fannie Mae loan slots. We call them Fannie Mae. They might be conventional slots. And typically we're seeing that an investor could get up to 10 of those.
Yeah.
So if you own your own home, you're down to 9. And if you do it right, depending if you've got a spouse or so you both qualify, you can really stretch out the amount of doors that you can get. 1 mortgage, 4 doors.
Yeah.
It's a very good use of the financing. And I would add as well, and once again, this is the monopoly progression we're talking about here.
Yep.
I like them a lot for the depreciation, the tax benefits too.
Yep.
Right? You're buying a $700,000 fourplex, brand new construction. How much more is that in sticks and bricks that you can depreciate?
Sure.
So if you're getting chewed up by taxes, they're just high, right? I met with my tax advisor last week. Rather, I complained to him. Okay. He was good to hear me out. He said, more real estate.
Yeah.
More real estate. It's the best way to lower your tax
That's
burden.
often the
and
answer.
so you package that up. You use those limited loan spots to acquire more real estate and better your tax position. It's just a great snowball, in my opinion.
Well, so good. There's tax, there's financing. Let's talk about this aspect of it. If I own a single family home, it is either 100% occupied or 100% vacant, right? It's not 5% vacant, even though you see performers all the time where someone says 5% vacancy factor. It's one of my pet peeves. Like, it's never 5%.
Right.
It's what the market says it will be. But in reality, a single family home is fully occupied or not. A fourplex, it's likely to be 100% or 75%. I mean, a rare occasion, maybe I've got 2 empty and I'm 50%. But more often than not, there's at least someone in there making a payment.
Correct. And I don't know if I view this too simply, but if I have a single family home and it's vacant, I'm coming out of pocket or I'm using funds for vacancy that I've allocated to deal with vacancy. If I've got a fourplex, my mortgage payment is the same every month, whether I'm 100%, 75%, 50%. The likelihood that I have nothing coming in to service that mortgage is very, very small.
Yeah.
With a single family home, it's high. I mean, you could be that's what really kills you on single family is that turnover. I mean, if your property's turning over once a year in single family, I don't think it's worth it.
Yeah.
Maybe at the end of the tax day you're getting a benefit, but you got to get those 18-month, 24-month leases, and that's fine. But you really do limit that volatility. I would say something about that though.
Yeah.
I see that begin to not be true when you're buying in not great neighborhoods. Because I think that tenants for multifamily properties, and this will come out a little bit wrong at first, but I'll clean it up. They're not the best tenants. So if you're buying in like a C-class neighborhood, you're getting the bottom of the barrel of the bottom of the barrel.
Right.
Right? You've got to buy in good neighborhoods where people want to be in the area because it's convenient, because of the schools, and it's desirable. Because then if you get the bottom of the barrel of the top of the barrel, if that even means anything, but I think you know what I mean, then you limit that risk. So it's tenant quality is, and you alluded to this at the beginning of the interview, that's really brought out more. It's magnified in multifamily. So you got to be a good landlord and you got to buy in a good area. Because otherwise, I've heard the horror stories. You know, I've got a duplex and, you know, I'm getting hammered on, you know, $1,500 a month in maintenance and people are always moving out. It's because nobody wants to live there.
Yep.
So, and I guess that's just a universal principle in investing in cash flowing real estate. Invest where somebody actually wants to live.
No, it makes so much sense. We did a show a few weeks ago on peace of mind investing. And the idea is that pro forma looks really good in the C-class neighborhood because the cash on cash return is higher. But the reality of delivering that, not just in terms of vacancy and turnover, the two most expensive things, but just full-time management and marketing and all the things associated with that. And peace of mind is jumping up to those areas where the tenant profile is such that they treat the home better, that the only reason they're not buying a house is they're perhaps in the area for a couple of years on an assignment, and that doesn't make sense to buy, or they're trying to figure out if they want to live in the area, or they just haven't been able to get that 20% together. A lot of great tenants have good incomes. They're good people. But today, for them to buy a house, they've got to, one, have the commitment long-term to be in a house, and that's going to bleed over to their personal life. Are they in a relationship that's solid? Do they want to be in the market long-term, or leave their options open? And then how do they get together that big pile of money to come up with a down payment? So my favorite tenants are the ones you're talking about. They're in desirable areas. And maybe on paper it looks like the return isn't quite as good, but you can sleep at night knowing that return is more durable.
Correct. It's durable. It's actually going to happen.
Yeah.
Right? I've had clients buy C-class properties and, some people you just can't talk out of it.
Yeah.
And frankly, there are some people that it's appropriate for. Some people can drive that ship like flippers.
Yeah.
Okay? And I get it. I'm not one of those people, by the way.
Right.
But, a low return on paper that actually happens is better than a high return on paper that never happens.
Those are very true words, and I'm glad you said those. We're going to continue our interview with Steve when we come back. Also play real estate trivia next, your chance to win a prize on the Real Estate Guys radio program.
Real estate investment advice right in your mailbox. Sign up for the free Real Estate Guys newsletter at realestateguysradio.com.
If you love real estate and have always wanted to own your own business, listen up. The Real Estate Guys and their panel of experts want to teach you how to go full-time fast in the real estate syndication business. These next few years may go down in history as one of the best times ever to acquire investment real estate. There are deals everywhere if you know where to look and how to assemble the resources. The Secrets of Successful Syndication seminar will show you how to make big money doing big deals from a team of experts that have syndicated projects totaling more than $1 billion. Don't wait for someone to give you a raise or create a job for you. Attend the Secrets of Successful Syndication and learn how to build a team, raise capital, find deals, and make full-time money in 6 months or less. Go to realestateguysradio.com and click on events. All the big players use syndication as a way to diversify risk, optimize profits, and earn big money. You can too. Go to realestateguysradio.com and click on events.
For investors, timberland has become the symbol of safety. Global tropical timber demand continues to surge as the world's population increases. The need for managed, sustainable timber production forests has never been greater. When stock markets crash, trees keep growing. Direct ownership of fully managed tropical timberland acreage is now available to accredited investors. Prime valuable hardwood groves close to the beautiful Costa Rican border generate and maintain superior long-term wealth. Qualified, accredited investors should email timber@realestateguysradio.com for more information. Consider visiting our forest plantations to see for yourself. Email timber@realestateguysradio.com. This announcement does not constitute either an offer to sell securities or a solicitation of an offer to purchase. Offering made by prospectus only. For more information, email timber@realestateguysradio.com.
Hi, this is Lawrence Yun, Chief Economist with National Association of Realtors, and you are listening to the Real Estate Guys.
Welcome back to the Real Estate Guys radio program. Thanks for tuning into the show. Great topic today, making the jump from single family to small multifamily properties. Before we get back to our interview with Steve Olson, it's time to play real estate trivia. Haven't done this in a few weeks. The last 2 weeks of prediction panels, we had so many great people on the line making their predictions for 2018. We didn't have time for trivia, but this week we do, and we're giving away a great prize. It's the excellent book from Robert Kiyosaki called Second Chance. That could be yours if you know today's real estate trivia question. In just a minute, I'm going to ask you a question that has something to do with real estate. When you think you know the answer, you can quickly get it to us by sending an email to trivia@realestateguysradio.com. Trivia@realestateguysradio.com. Include your name, your mailing address, and the answer to the question. And the first one who gets it right will get a copy of Second Chance. 3 weeks ago, our last trivia question was this: what country is the North Pole in? Well, all that discussion around the holidays around the North Pole. Here's the answer. The North Pole is not in any country. It's actually considered part of international waters. A fun fact, and it may be obvious, is that when you're standing on the North Pole, any direction you point is south. Here's our real estate trivia question for this week. In what city was the United Nations Charter drafted and ratified back in 1945? Yep, what city, what large piece of real estate was the UN Charter drafted and ratified in 1945? If you know or want to take a guess, get your best guess to trivia@realestateguysradio.com. Include your name, the answer to the question, and your mailing address so that if you're the winner, we can send you Second Chance by Robert Kiyosaki. That's today's real estate trivia question. We're talking with Steve Olson today about investing in multifamily properties, specifically under the commercial loan limit, so 4 units and below, but above the single family house. And we've talked about the reasons that makes sense from occupancy, from finances, from tax, and from kind of neighborhoods. Now let's talk about what you guys have been doing about this, because this is a great solution. You guys develop and build brand new multi-unit property. Tell us about that.
When we look at that kind of property, I've seen a couple of problems in the marketplace. The first one is cap rate compression. That's just a fancy way of saying that fourplexes are expensive right now.
Well, and no investor left behind. That's because more people are bidding on them, driving the price up,
Yes.
but that doesn't make the rents go up. So the return on investment comes down.
That's correct, because they view it as a safe haven. People traditionally view a well-operated fourplex as something that's going to take care of them in a down market, in a sideways market, and in an up market.
Which I would agree.
Yeah. And now there's more capital out there. People want them. They've bid the prices up, and that's a problem. I can't speak to every market that your listeners come from, but I can speak to most of them because I talk to investors from all over the country every day. And they go out with realtors. They try to find these, and they are underwhelmed. They think, I got to pay that for that, right? This thing was built in the 70s. It's run down, and what the seller is asking is ridiculous.
Yep.
And you know what? They're probably going to get it.
Yep.
Right? So cap rate compression, and you navigate that by finding value add opportunities. An investor might find a distressed fourplex, a distressed seller that needs 10 grand in carpet in each unit, got to kick out some tenants, got to do you got to do some things. You got to have some maneuvering. And then when it's all said and done, you got a respectable cap rate. What we've done there is we've taken a new construction approach. That's the value add, because our clients aren't the kind of people that can go do a postcard campaign and knock doors and hustle these deals that are value adds. They're busy. They're professionals. They're good at making money doing what they do, but they want a better return.
Yep.
So we build these brand new fourplex construction developments where clients essentially acquire them pre-construction. And that's the value add. When you take risk off of a builder's shoulders, right? We help you come in with construction financing. You're rewarded by getting a better price.
Yeah.
The builder says, hey, I don't have to carry that. I don't have to carry all that interest. I can draw down on a construction loan here. Well, here you go.
Yeah.
So they get a better cap rate that way. So you could do it one of either way. You know, each one is kind of depends on the investor. We've seen a second problem here, and I know you've seen this. I know almost everybody has seen this. When you notice a little cluster of fourplexes around town, some guy built 30, 40 years ago, they're usually pretty disgusting.
Yep.
Okay. And it's because a builder puts that up, he sells them off, maybe keeps one, and nobody's minding the store.
Right.
Yeah, we've all heard of the broken window theory. So fourplex A, the shingles start to curl, gets nasty. Maybe they hang a Dixie flag in the window, park their car on the lawn. Well, what's going to happen when the guy across the street needs to lease his?
Yeah.
What just happened to his rents?
Exactly.
And down the tubes, everything goes. So it's kind of a 3-letter word, HOA, but we set up an HOA for every one of our developments, and the only members of that HOA are our investors. The guy next to you wants to put crappy tenants in his property. HOA is calling him on that.
Yeah.
He's not getting away with that. And in addition, in the budget of the HOA is maintenance of all of the exteriors. Roof replacement, exterior maintenance, groundskeeping, snow removal, if that's applicable. So that way these things look the same way in 15, 20 years as they do today. We want to preserve that because it goes back to what you said, what we were talking about. You got to have good tenants. Good tenants want that stuff.
Well, and what I frankly was amazed at is how beautiful these units are. I mean, I was not expecting them to look the way they look based on, you know, the type of property that we typically associate with a fourplex or a duplex, right?
Yeah.
This is a higher end property in nicer areas, and so you are going to get that durability of tenant. I mean, when you build a lot of these together, it feels like an apartment complex to me more than it does a, you know, random rental neighborhood where there's some multi-unit properties.
Yeah, it feels like a nice apartment community that you walk into. You can tell there's one set of rules across the board.
Yep.
Right? The parking is all handled. You know, most of our projects have pretty good amenities like a clubhouse and a pool. I don't know that everybody is using the same terminology here, but I would consider them to be in A+ neighborhoods, A+ type communities. And it is cool. You know, I'll brag a little bit about it. Our builder that we've been hooked up with that does these came up with this townhouse style concept. So a fourplex in our eyes is 4 townhomes in a row, 1 tax ID number.
Yeah.
And that gives you a great benefit from the tenant's point of view because they go, this isn't just like a boxy little fourplex, right? You know what I'm talking about, that 2 up, 2 down type fourplex that we've all seen. And it's just, Well, in a tenant size, they get a 3-story townhouse, 1,700 square feet,
Yeah.
a garage, amenities. So I think you get a lot of the pros from multifamily investing, some of the pros that come in from townhomes, the great financing you can get with single family investing, and it just kind of throws them all in one pot, makes a pretty good deal.
Well, the other thing I like about it is kind of the target demographic you're at in terms of investors, because when we start out, we're limited by whatever our personal budget is, and we might be able to buy a little single-family house. Then you get up to the folks who want to own 100, 200, 500 apartment units, and we know a lot of those folks, but that's a whole nother world. That's a whole nother learning curve. You're competing, and today, talk about cap rate compression. I mean, the multifamily space is crazy like that, and yet we have more tenants on the way. The population is increasing. We're actually, if you do the math, running out of housing, and this is an area that people have not focused on, right? That nice townhouse style unit that is a rental unit, and so you're going to get a quality tenant who's likely to stay longer, likely to take better care of it. That's not what the big apartment guys generally buy, except, Class A REITs and insurance, pension funds, all those folks. But your average apartment investor, that's not what they're after. Single family home investors, that's usually priced out of their market. So let's talk about that part of it, because this type of an investment is a little different for a couple reasons. First of all, you attract an investor before it's built. And that's a point I want people to understand, because you mentioned this, but I don't want it to get glossed over. When a developer goes and puts a property plan together, they're going to build something. One of the biggest things they have to figure out is the risk, the timeline, and what their profit's going to be. Typical builder profit might be 10 to 15%. Builders aren't making 50% profit, and hopefully they're not making 3% profit, right? There's got to be a healthy enough margin in there. But if you can remove risk from a developer's plate, that's worth something. We did this a bunch 10, 12, 15 years ago. We would go in and to go to a builder and buy all of their inventory. And if we would do that, they would give us a better price because we were taking that uncertainty away.
Correct.
And that's what an investor in this case is doing. They're taking the uncertainty away, and therefore they're getting a better price.
That's the value add. That's what I was saying earlier, is you've got one of two ways to do it. Go find an old rundown fourplex. You got to kick those tenants out as the leases expire. Go ahead and remodel it, release it, and you can get a great deal if you're good at finding those, if you're good at that process. That's your value add. If you don't know how to do that kind of stuff, or you don't want to do it, then what you just said is the value add. You take the risk off of the builder's shoulders.
Right.
You take away that uncertainty, and there's a value to that. It comes in the form of a better cap rate.
Some homeowners will go to a new development and they'll put a deposit down to buy a property that's not going to be delivered for 18 months. But your typical buyer, they want to move in a few months, right? They don't want to wait. Investors, we don't care that much, right? If we can secure the property and we know that it's going to perform and we've done our due diligence in the market and the builder and those kinds of things, then if it takes a while to build, that's okay, right? So that's another advantage an investor has when they're buying this kind of property. Take us through what the process looks like. Since you're starting with an investor before it's even built, how long does that take to, first of all, have something available, and then what would they expect in terms of delivery and those kinds of things?
It can vary a little bit, but I'll just give you a possible scenario here. Usually, right now, for example, our land guys are working on a couple. They're talking to the city, preliminary due diligence. I mean, this stuff starts way in advance.
Yep.
Okay. And so they'll come to us and say, hey, we've got this piece of land we can do. We can probably get X amount of units on there. And then we start digging into that thing. Schools, projected household formation, rental demand, comps, amenities. What's this going to look like? And we'll put together a preliminary pro forma on what we think this thing is going to look at. And it's based on today's numbers. Okay. So, and there are some pros and cons to that, which I'll get to in a minute.
Yep.
So we'll put that thing together, and typically we release a project anywhere from, maybe 4 to 6 months before we can start building in the first phase. And people are essentially reserving a unit. They put a deposit down at $10,000. It's fully refundable. The point of no return is when they get the final plat recorded with the city.
Yep.
Okay. Now we're doing this, right? Now this big chunk of dirt has been divided up into 40 chunks of dirt upon which these fourplexes can and will be built.
Yep.
And so depending on where an investor might be in the phasing of the project, that's when they start. So we'll have them set up with construction financing before then, assuming they qualify. We handle all that on the front end before they reserve anything.
Okay.
And now they got to hurry up and wait. And this is what'll drive them crazy. It would me too. And you just have to look at it at the perspective of what's your alternative. You can go do value add opportunities. but you end up waiting on those typically. So
Yes,
you'd probably just rather have something new. So that's the mentality that most people arrive at. And I get it. It's not for everybody, but most people end up liking it. So construction begins. Typically, the construction will take 12 months, right? If it was just one fourplex, this thing would take 6 months.
Right.
It's 40 of them.
Well, not only that, that's part of the big value add, right?
Yeah.
If it was just one fourplex, you can't control what the neighborhood looks like and what's next door. And this, by being part of this community, and 6 months goes by before you know it.
Yes, it does. And so this thing gets built. You could be looking at about 18 months front to back between when you say, give me that fourplex, and you actually have a fourplex.
Yeah.
So you'll close on the construction loan, right? And that's when you come in with 25% down plus your closing costs.
Yep.
You'll talk about that with us. We'll kind of walk you through it. There are a couple options to where you can limit your closing costs a little bit by wrapping them into the loan. And then you go through that process, and then our property management guys take over about 60 days prior to completion. They start marketing.
Yep.
One big mistake we made early on in this was, hey, manage your property. Have whoever you want manage your property. And you're nodding your head. But that of course did not turn out great, right? You have to have one sheriff in town.
Yep.
Okay. Because this is a lot like an apartment complex. And if there's 7 managers walking around quoting different rents, using different marketing, we can't stabilize the project very effectively. So we instituted a requirement where everyone uses our management for the first 2 years. People rarely leave after 2 years because when there's one sheriff in town, it's better rents for everybody.
Well, it is. People don't realize this, but they think they want the choice to be able to find a new manager. In reality, when you have multiple managers in a project like this, it's a race to the bottom. One guy's renting his unit at $1,200, and another guy's like, I need money, so I'm gonna go $1,125.
Yep.
And someone goes, no, I'll do $1,095. Before you know it, it's a race to the bottom.
Right.
Whereas if you have a single solution, it maintains the integrity of the rents.
Correct. And on a race to the bottom, you might have market rents way higher than the bottom. It's just one person making a stupid decision. It goes back to that broken window theory,
Yep.
right? So we instituted that process, and about 60 days prior to completion, the management team will get in touch with you. They'll kind of give you a feel for what's happening. For example, right now, as we record this, it's a slow time of year, no matter where you are, to rent units.
Sure.
So they'll say, hey, we might have to give a concession away, or it'll take a little longer. Who wants to move in mid-December?
Right.
Right. And that's part of the business. And one great thing they'll do there is when they do sign that lease, they're going to sign it on as either a 6-month or an 18-month. Want to get you out of that November, December cycle.
Right.
We want those we want those units coming online in May, June, July.
Excellent point.
Instead.
Boy, you could be in real estate a long time and not think of that. There's a nugget right there. Good stuff. Hey, let's talk about the price of these units, because obviously they're brand new, they're beautiful, they're in these nice neighborhoods. So we're not talking about a subpar property in any way. What's a fourplex, a brand new I know they're different in different areas, but just kind of a thumbnail of what a fourplex might run.
You would be anywhere from $650 to maybe $800.
Okay.
Right? To give you a feel for that, $650, that's going to be in the northern suburbs of Houston, Texas, like Spring or Cypress.
Yep.
If you're $800, that's a bigger unit in the Salt Lake City metro.
Okay.
Right? Something maybe with a basement.
If we do some math on that, it's going to be 25% down, you say, and
Correct.
That's the construction loan, and it becomes a permanent loan?
They'll do a refi at the end when it's built.
Yep.
And most investors usually just wrap the cost of the refi into the new loan.
Yeah.
And I forget it's probably $6-7 a refi, one of those kind of loans. It's
Yep.
not right. And so the appraisals are typically there to do it because
Sure.
of that risk you took on. Remember, a higher cap rate, that equates to equity. That's what that means.
Right.
Most investors decide to do that. They say, I've spent enough money. I'll go ahead and wrap it in. And what does it do? It raises your loan by a couple bucks a month. And so they just say, I'd rather have that money in my pocket.
Yep, absolutely. So the idea is that 25% down, 75% loan, and then over time, these units are going to continue to be rented, and you'll see whatever rent escalations might happen in the marketplace. Let's talk about exit strategy, because it is a little more limiting. If I'm selling a fourplex, I'm obviously selling to another investor. How does that part of it work?
Sure. Right now, it hasn't been as limiting, and I'm not going to sit here and tell you it's going to be that way forever. What's been happening now, because the appetite for these properties keeps going and going, investors have had a unique exit strategy where they can have us just list this thing when it's complete.
Yeah.
And you got these 1031 exchange buyers coming out of California. They're going to have to pay $90,000 in tax if they don't buy something. Well, there's that 5% cap rate that the market is absorbing right now.
Yeah.
So if our client bought it at 7 or better, they can sell it at 5. They just made a chunk of change. Now, they do have another problem. What are they going to do with that money?
That's always the problem.
You got to buy
right?
something with it. Nobody feels sorry for you when you have that problem, but it is a problem.
It is a problem.
Yeah. Another way is you got to wait and see what the market does.
Yeah.
Right? These are sold and valued based on cap rate. So you're going to be selling most likely to another investor.
Yeah.
And that's the funny thing. Investors are not as sensitive to what the market is doing. Right? For example, I just said 1031 exchange buyers, even though we're in a cap rate compressed environment, well, they got to buy. Right? It's time to do it now. Otherwise, horrible tax consequences.
Yeah.
Other times, maybe you've got a better opportunity and you can sell at a price that is good for you. Your principal is paid down. It's something that you're not going to get into because you want to hurry and get out of. I think a fourplex investment is something you say, I'm going to park that money. And if in 2 years it makes sense to sell, I'll look at it. If it doesn't, I put enough down, I have enough rent, so I can just ride this thing as long as I need to, another benefit of that 30-year fixed mortgage.
Yep.
You don't have to do anything. You can wait for the right time to sell.
Now, obviously, fourplexes make a lot of sense for the reasons we talked about. You're trying to get the bigger loan. You're trying to do more. It's not all you guys do. You actually do have 2 units and different configurations for folks.
Yeah. It's not a very fancy answer, but typically our development guys and the engineers are going to look at a plat and they're going to say, we can get 10 townhouses in a row here, 2 fourplexes, and there's 2 left on the end.
Yeah.
That's a duplex. They'll plat it as a duplex, give it a single tax ID, and you get a duplex for about $350.
Okay. Awesome. Well, rather than get into all the details, the numbers and the timeline and all that, you guys have done a report that kind of outlines some reasons why people are interested in this, as well as gives them the ability to reach out and get the details. But before we tell the listeners how they get a hold of that, let's talk about market you're in. You mentioned Houston, you mentioned Salt Lake City. As this program expands, what are some of the markets that you're in and planning to consider?
We got our start in Utah, in the Salt Lake City metro back in 2010. The market was not doing well.
Yeah.
And that's why I love this model of fourplexes, whether it's from us or whoever. It does well when the market's not doing well.
Yep.
Right. And that's the ultimate litmus test, in my opinion. So we started there. We've got to be up in the neighborhood of about 1,500 doors that we've built. And this is spread out over multiple developments. And a few years back, the ownership and the big wigs decided, you know what? If this works in Utah, this is probably something people want elsewhere too.
Yeah.
And we happened to have a good crew on the ground in Houston, and we were seeing a lot in Houston that we like because Houston, it's no secret that oil prices have been down, but still adding to the population, still growing, companies still moving in. It's a cheap place to live. It's an international hub. It's a shipping hub. It's a good market.
Yep.
So that was the first market that we had expanded into. We've got more inventory coming in the Houston market. We eventually, soon thereafter, went into Boise, Idaho. It's not too far from us, easy for us to get the right guys on the ground. We set up our own management wherever we go. It's got to be us, right? We're the only cook in the kitchen. Okay, so we went into Boise, most specifically in Meridian, which is a suburb of Boise. It's growing like crazy, right? Businesses, when they're tired of Seattle and Portland, but they want to be in the upper Northwest, they go to the Boise area. We've got dirt under contract in Mesa, Arizona.
Okay.
Still looking at other markets. We've got a few things we're toying with, but we only move this as fast as we can grow the property management in the area and as fast as we can bring on, the right builder team in the area.
Well, when you get an investment that works for you, one of the ways you avoid being too many eggs in one basket is diversify across markets.
Correct.
And it sounds like you probably could have that figured out for folks so that they could, if they like the investment and the way it works, they like the returns and the management and this idea of brand new, which who wouldn't, then it's pretty easy to diversify market-wise because you guys are looking at different markets.
It does make it nice. We've got the same lenders and insurance people across the board. You can manage everything under one roof. Same kind of product type, just a different market. So there are lots of markets we're looking at, like I said, but you got to go at a pace that you don't have bad growing pains.
Yeah, for sure.
Yeah.
Now, when we come back from our break, we're going to tell folks how they can get a copy of your report and learn everything they want to learn about this. But let me ask you this. You've had now all these units and you've got lots of investors. What's the thing you wish new investors knew going in that maybe has been a challenge for folks?
I have to tell them this over and over again. More people are listening, but some people just don't listen.
Yeah.
And it's that pro forma is only as good as the neighborhood that the property is in.
Yeah.
That's it. You've just got to know that. And also, too, when you're buying real estate, you're not buying treasury bonds. Okay.
Right.
Nobody's guaranteeing you anything, right? You got to be a big boy. And sometimes properties have maintenance. Sometimes things take longer. That's why you're shooting for the better return.
Yeah.
So that's normal. When something goes wrong, I hate to say it, but that's normal. Right. And I'm talking in reference to all properties,
right,
not
sure.
just what we do.
Yeah.
Right. Maintenance happens, move outs happen, evictions happen. It's part of the game. I don't think you can really effectively manage or kind of look at the return of your real estate over a couple of months or maybe even over a couple of years.
Right.
I mean, this is a long play that you're making here. Right. And that's the lens that you have to view it through.
All right, good stuff. Well, this has been amazing. Happy to have you on the program and learn about this. Frankly, I wish more people were providing this kind of inventory, and it's no wonder you have a waiting list, but as they say, you'll go out and get more. So if you're very interested in what Steve's doing, and you should be, when we come back, we're going to tell you exactly how you get a copy of the report they put together, which outlines some of the things we've talked about in terms of why this investing makes sense, but also you'll be able to see what the units look like and get some idea about the numbers and all that kind of stuff. So thanks for being here today.
Thanks a lot.
You're tuned to the Real Estate Guys radio program. More when we come back. I'm your host, Robert Helms.
Need help with your real estate investment portfolio? Check out the resources page at realestateguysradio.com.
Memphis is famous for being the home of the king of rock and roll, but it's also the king of cash flow. If you're looking for affordable cash flow properties, it's hard to beat Memphis. Get your portfolio rocking and more cash flowing your way by calling Terry Kerr at Mid-South Home Buyers. Terry's the king of turnkey properties. Contact Terry through the resource section at realestateguysradio.com. And be sure to order Terry's tips for turnkey rental property investing report. It's free. Just send your request to turnkey@realestateguysradio.com.
If you want to retire in the next 5 years or less through real estate, then please pay close attention. My name is Brad Sumrock, and I've taught thousands of my students how to replace their incomes, quit their jobs, and retire faster than they ever thought possible by not investing in single-family homes. You see, there's a secret to retiring fast with little risk, and it has nothing to do with being a landlord, fixing toilets, or flipping houses. The secret is multifamily apartment buildings. Starting from scratch with zero experience, I managed to pocket over $1 million in cash and retire from my 17-year corporate job within 3 years of apartment investing. Now, this is not your typical no money down real estate training. We believe in smart, hard work for intelligent people. So if you're good with your finances, have a decent job, or saving your money, and you're looking for a change and getting out of the rat race, then investing in apartment buildings might just be the answer you've been looking for. Send an email right now to sumrock@realestateguysradio.com to get the details of my upcoming training event. And you'll also receive my free training webinar, Apartment Investing for Beginners. That's Sumrock, SUMROK, @realestateguysradio.com.
Hi, this is Mauricio Raul, founder and CEO of Mir Law Group, and you're listening to The Real Estate Guys.
And welcome back to the Real Estate Guys radio program. Thanks for tuning into the show. My gosh, a wealth of knowledge from Steve Olson.
Yeah, that's what I love about just being the co-host of the show, and the fact that so many interesting people contact us and want to tell their stories. I wish we were doing an episode a day because there's so many things we could talk about. But there's a lot of really smart people out there that are finding great ways to make money in real estate. They find great markets, they find great business models, they find a way to add value, and it's always exciting when we have a chance to share that with our listening audience.
Absolutely, and if you're interested in this idea of a brand new fourplex or duplex, here's what you do. Send an email to fourplex@realestateguysradio.com. fourplex@realestateguysradio.com. Steve and his team have put together kind of a summation of the things we've talked about today, many of the points. And one thing I appreciate about what they've done here is it's both the pros and the cons. Even though they do help investors find this kind of inventory, as Steve said, whether you buy something from them or from anybody, these are the things that hold true. And so it's good information if you're thinking about making that jump up to multifamily, or maybe you're already on a couple of fourplexes and you just like to look at something brand new. Well, fourplex@realestateguysradio.com.
Yeah, I think the important thing is that you're looking for new ideas, you're listening to new perspectives, you are trying to find a way to figure out what's out there, what's available, and then relate it back back to you and your personal investment philosophy, what you're trying to accomplish, what you have to work with, what you're willing to do, what you're not willing to do. And the more ideas, the more perspectives, the more opportunities you're looking at, the more likely you are to find something that's going to kind of hit center mass of your target and what you're trying to accomplish in your life through real estate.
You know, it would be great if we could get together like that and have those kinds of people around like for a week and just hang out and immerse ourselves in conversations with people from all over the world who invest in all different markets and all different product types and just hang out and pick their brains. That would be awesome. We should do that.
We should do that. In fact, as a matter of fact, we do that. We do that every year on our Investor Summit at Sea, and it's become something epic. You talk about the evolution of an investor. We talked about that at the top of the show. You start out single family home and then you move into bigger and better properties and more sophisticated structures. Well, the Summit at Sea started out, 15 years ago, and it was a bunch of people getting together talking about real estate investing. And we did that for several years and it was great. And then 2008 came and the weakness of incestuous thinking was exposed. And we realized, there's a big world out there that affects us as investors, not just real estate investors, but as investors, and that we need to understand the ecosystem, the economy, the sea that our investments float in, our real estate investments float in, and what affects interest rates and what affects the value of the currency and what affects employment and migration and all these macro things. And so the summit began to evolve into something where we were hanging around people that were really outside the real estate realm. We had plenty of real estate, and we still have a lot of real estate exposure, but we wanted to open that up. And it really does take a fair degree of conversation. You get stimulated from the front of the room by a presentation, but that isn't the end of the learning. That's the beginning of the learning, because then you follow that up with conversations with the speakers, then other summiteers, we call them, at dinner and cocktail parties, and you continue that conversation going. And man, by the end of the week, you get more done in that week plus. It's probably about 8 or 9, 10 days, whatever it is, but you get more done than most people get done in 10 years in terms of depth of understanding, breadth of understanding, awareness of opportunities, and relationship building with strategic people. I mean, you get more done in a week than you get done in 10 years.
It's 2 days on land, followed by 7 days on a luxurious cruise ship. You can find out all the details on our website at realestateguysradio.com. Click the button that says Summit at Sea. Definitely want to hang out with us and an amazing faculty in April for the Investor Summit. Hey, big thanks to Steve Olson for his contribution today. And if you want a copy of his report, just send an email to fourplex@realestateguysradio.com. Until next week, go out and make some equity happen.
Hello, this is Robert Kiyosaki, and I'm very excited that I'll be joining the Real Estate Guys for their Investor Real Estate Summit at Sea. Join me, join my friends, join the Real Estate Guys Investor Summit at Sea, and I'll see you out there. Thank you very much.
This episode of the Real Estate Guys radio show is brought to you by Paradigm Life. Powerful cash management strategies using life insurance. Learn more at beyourbank.com. Mid-South Home Buyers. Low-cost, turnkey cash flow properties in Memphis, Tennessee. Corporate Direct. Asset protection strategies for real estate investors from attorney and Rich Dad advisor Garrett Sutton. Find these and other great companies under the Resources tab at realestateguysradio.com. To learn how you can expose your product or service to the Real Estate Guys audience, call 888-489-7723 extension 4. That's 888-489-7723 extension 4. Or use the feedback page at realestateguysradio.com. Thanks for listening, and we'll see you next week right here on the Real Estate Guys Radio Show.